Working Cows Podcast, episode 360. This episode is brought to you by Ranch Right. This episode is also brought to you by the South Dakota Grassland Coalition.
Welcome to the podcast that gives producers a platform to discuss and share paradigm-challenging practices. Practices that have increased the effectiveness of their operation and the joy that their families have received from this lifestyle.
Howdy, everybody. This is Clay Connery, host of the Working Cows Podcast, recorded exclusively in the Understanding Ag Studios. And this episode is brought to you by Ranch Right. There are 3 guarantees in life: death, taxes, and paperwork. Ranch Right can help you avoid one of them. If you're a successful business, you're probably paying some taxes. But that doesn't mean you have to be stuck inside preparing your paperwork for the accountant. Enlist the team of financial experts at Ranch Right to get you back outside doing more of what you love. They're committed to providing you with actionable financials so that you can build a profitable business and create generational wealth. While some things in life are inevitable, being mystified by our numbers doesn't have to be. If you're ready to entrust the paperwork to a team that actually enjoys this type of stuff, then visit ranchrightllc.com today and get back outside to more of the things that you enjoy. Very excited to be joined today by John Haskell. He is the CEO of Ranch Right, and he is joining me to talk today about taxes on April 15th. We're talking on taxes on the day that taxes are due to be filed. So if you're looking to plan for next year, here's your opportunity. This is a conversation that I had a while back with John, but very good conversation, very detailed and very thorough, and really appreciate him taking the time to get prepared and to lead this conversation. So here's my conversation with John Haskell. John, thanks for joining me today on the Working Cows Podcast.
It's an honor, Clay. Thank you very much. This is always fun.
Yeah. And given the season that we are in, and kind of where everybody's head's at, it's always a struggle in podcasting. Do I release it in the season that we're in, or do I release it before that so that people can get ready for the season that they're in? And that's kind of the benefits of producing evergreen content, is you just release it when it's on your mind, and then somebody can go back later and listen to it again and use it to get ready. So anyways, we're in tax season here. And I guess what I wanted to talk to you today about is, how do we get ready for tax season? What kind of things should we be keeping track of? What kind of things should we be paying attention to? What kind of systems should we have in place to capture and record and keep track of those things, so that I would imagine that means that the bill is smaller from the accountant, when you turn those things in an orderly way, and they don't have to spend hours and hours sorting through all those things. And so, yeah, just some of that kind of philosophy of this strategy, and then some of the actual practical, what do we want to be paying attention to?
Yeah, love it. This is an important time of year, as you mentioned, and I'm just going to tell you, if you're listening to this episode now, certainly be ready to replay it for yourself for next year, because the biggest thing is preparation is key, right? With so many things. Although that said, we are in February, and so it is not too late to get ready for 2024, even though you're currently scrambling to get 2023 put together. But we strongly advocate, tax preparation for 2024 begins on January 1st. And that has a couple of important components. A big one is obviously just managing things, making a plan for how you're going to manage things like receipts. But for some people, it also means having a strategy of how you're going to manage your business so that you can manage your tax bill. And before we jump into that, I want to just talk a little philosophy here. I love the phrase, do not worry about taxes more than the rate you pay. So if you currently don't pay taxes because you don't have a tax liability, or you don't, or you pay a very low percentage of your, actual income or a small dollar amount annually for taxes, don't spend a lot of time worrying about it. That excludes, of course, preparation, which means, doing things like keeping track of expenses, just like you say, so that when you go to your tax accountant, you actually have, things well documented to make their life easier. We hear the comment all the time. We see it all the time. Your tax preparation bill generally will be lower if you are prepared. If you take a whole mess to your tax account, you don't have half the stuff and all that, it's likely that your tax bill may be higher, but your tax preparation bill most certainly will be higher. Most accountants bill by the hour. So if you make their life harder, it takes longer, it costs more. But let's do a few philosophy things first. And I want to make sure that I always start by saying, and I'm going to end by saying this too, if you'll remind me, never cheat on taxes. Never, never, never cheat on taxes. There's really no two ways to say it. There are lots of wonderful tax strategies that are available to us that allow us to manage taxes. The tax code is full of gray area. Those are, matters between you and your tax accountant as far as where you live in the gray. I'm good with all that, but there are things that are illegal, and we do not do those. And I will tell you that IRS is not somebody you want to mess with. Pretty easy.
Jesus said, "Render unto Caesar what is Caesar's."
I love that quote, and that's exactly right. Yeah, good.
He didn't say anything about doing it joyfully, I don't think, but he did say.
He did say to be joyful in your persecutions, though, and I think that would fit very appropriately for some people.
All right, you got it.
Good, but that's the perfect reference, and that is good advice to follow, right? Which is now we can argue about taxes and the generality of that, and I do think it's appropriate for me to sort of give you my biases, which are the tax code is the rule of the road. I'm going to come back to that in a minute. I believe in general that government spending is both essential and simultaneously incredibly wasteful. We all can think of examples where the government does terrible things with what I think of as our sacred money, right? They collect it under severe penalties and often do crappy things with it. So I have become a believer, seeing the inner workings of government. I've become a believer in very limited government, maybe enough so that makes lots of people uncomfortable. I don't say that because that's where I'm coming from. Just that's my bias. So if it comes up, that's what it's going to tell us. The other thing is wonderful people like Art Laffer, who's famous. If you've ever seen Ferris Bueller's Day Off, you learned the Laffer curve taught by Ben Stein, right? A fantastic economist. Higher tax rates don't generate higher tax revenue. There's a big distinction there. And there's a wonderful book a new book that Laffer is a co-author on called Taxes Have Consequences. It's available on Amazon. If you're a geek like me, interested in this stuff, it's fascinating. My wife watches me read this book and it's like, you're reading a book on taxes before bed? Like, anyway, and it keeps me up at night. It doesn't put me to sleep. So anyway, taxes are ways to influence people's behavior. And the important thing that Tom Wheelwright and some others point out, Laffer also, is that when taxes are put into place, especially deductions, credits, those sorts of things, they are designed to get people to do things. So, for example, there is a tax credit for providing housing to people. There is a tax credit for exploring for oil. There are currently tax credits for driving electric vehicles, right? The government wants you to do things and they're willing to pay you for them. We have some wonderful tax benefits in our industry. The government wants people to raise food, right? They want us to pursue conservation practices, all those sorts of things. And they motivate those primarily through the tax code. We can have a debate about whether that's the best way to do it, et cetera. I don't want to have that debate. I just want you to know that those are the rules, and following the rules is our duty. So that's what we do. That is the rendering unto Caesar part. And people like Tom Wheelwright make great arguments that, there is a real case to be made for, hey, we're trying to get these things done. Let's help, right? There are wonderful benefits to providing housing for people. There are wonderful benefits for growing food. We don't just do it for the tax benefits, but the tax benefits can augment our otherwise good efforts. So I think that's most of my... Oh, the last thing is, again, for me personally, my goal is to maximize after-tax wealth. And some people have the goal of paying no taxes. And that can be a goal that's valid. I think that's it's a less interesting goal to me because, again, what we're trying to do most of the time and what we're trying to do with our clients is build really profitable businesses. And then we'll worry about the taxes afterwards. But there could be two strategies. And I mentioned business strategies earlier as a form of preparation, but there could be two strategies that yield the same amount of profit, but one leaves more money in my pocket at the end. And that is an important distinction. And again, there I'm generally only talking about situations where you're already in a very profitable business. A poorly profitable or a moderately profitable business often doesn't have much of a tax issue. This comes down to the fundamental principle of compounding within our businesses. And if compounding is the idea that the money you make then makes money, right? So when we think about this from investing, I invest $1, the dollar makes 5 cents. Now the 5 cents earns interest, on and on. When I compound in a profitable small business, I have the opportunity to grow my money effectively, with the power of an exponent as opposed to just addition. When I pay taxes, I take money out of my business. Now, there's a level of taxes we have to pay. I'm fine with that. But if I have a strategy that leaves more money in my business and optimizes my tax level, it allows me to compound at a faster rate.
Yeah, no, that makes a lot of sense. And I was just in a meeting the other day, and one of the significant players in that meeting said, it's my experience that ranchers will slit their own throats to avoid paying taxes. And I think that is the opposite of what you're talking about.
Correct.
Like, we need to make sure the business is really humming, and then we'll figure out how to pay the tax bill.
Yeah. And that said, I don't know about you, but there is nothing less fun than writing a check to the IRS at the end of the year. This whole thing about payroll deductions and how they hold it, I think they need to make everybody write the check. Like at the end of every month, you're going to sit down and say, okay, I made $1,000 and here's $300 that I get to send to the government. Like, It's painful and it sucks, but yes, don't be stupid about it. Right. Just do it correctly.
Right. From a philosophical perspective, and maybe you're going to get into this, but would it be the case that you want to try to bump up against the top of the bracket rather than be, just over the line? Like if you realize, if I make that much profit this year, which we're all understanding, ranching for profit, planning for a profit, understanding those things ahead of time, right? But if we realize, I'm going to make this much profit this year, it's going to put me just over into the next bracket. Is that worth saying, well, maybe we don't want to do that this year, or maybe we want to figure out a way to scale it so that we get to the top of the bracket instead, or whatever?
It's a great question. And it's something you hear a lot of. And I find it fascinating because, again, if you're a U.S. based listener, especially, I think you have audience, I know in Canada and probably in Australia, New Zealand, English speaking, our tax codes are all fairly similar. But in the U.S. especially, we have these sort of very distinct breaks in the tax code, percentage wise. And the thing to remember about that really matters is, yes, sometimes adding another dollar kicks you up into a new bracket. But what you have to remember is that it's only the additional dollars that are taxed at that rate. So let's say I'm in a 20% tax bracket and I'm going to jump to 30 and I made $100. Well, if I make $101, the first 100 is taxed at 20. The $1 is taxed at 30. Now you can decide if you'd rather have the 70 additional cents or not, but almost always, and there are states like California, Illinois, New York, that their state income tax on top of the federal income tax. I mean, at one point, I don't know if it's still the case, but at one point, California's top marginal income tax on W-2 earners was over 62%, right? So at that point, and this was within the last few years, I don't know what it is now. I haven't kept up. But again, at that point, do you want to add $1 and keep, 38 cents? Maybe not. You can make that decision. You're still better off with the 38 cents. Right now, if it depends what it costs you to make it, that sort of thing. But those are places where we often try to shoot for, my goal, an optimal strategy in my mind. And again, this is just one man's opinion. is that you do sort of play those brackets. You put yourself comfortably into one of the lower end brackets, and then you pay those taxes. Again, there's nothing wrong with putting yourself in a situation where you pay no taxes necessarily, but it isn't necessarily the most. It doesn't generate the most wealth. Right? You may be, just like you say, slitting your throat to get to that strategy. Now, one thing that is, from a strategy standpoint, that everybody, particularly young people, have to understand is that growth is tax deductible in large measure. And I should qualify everything I say here, except don't cheat on taxes, is like generally. Okay, we're going to make some super broad generalizations here. And I've never gotten hate mail from a podcast episode, but I'm sure it's coming. But these are the places where we get in trouble, right? So when we grow a business, small business is something the government wants us, that's an activity they want us to engage in. Well, sometimes they make it seem like they don't, but they really do. And small business is a lot of what powers our U.S. economy. Same in Canada, same in Australia and New Zealand. Growing that business, investing in that business is tax deductible. The part where we slit our throat is often where we buy expenses or assets that are really expenses, right? In kind of the Kiyosaki type definition, assets that take money out of our pockets, and especially if we finance them to reduce our tax bill. We can buy stuff, though, that increases future tax liability, or potentially does, or increases our cash flow, and use that to save on our taxes. And to me, that's the best strategy, right? If I can grow my business, if I can invest in more livestock, if I can invest more in the things that generate more income, and that is tax deductible, that is a wonderful strategy. Does that make sense?
Yeah.
Okay.
Yep,
so I can I can make a down payment on a tractor and finance it to get a tax deduction. Okay. And then I have debt that I now need to pay with after-tax dollars to get that thing paid off, right? That can be an absolute killer. We watch people do that over and over again and put themselves out of business. But if I buy cows, for example, and I can run a cow profitably, then now I am making the problem potentially worse next year. But then next year I can go buy more cows. And you say, well, but my ranch is only so big. Well, yeah, but there are lots of ways around those things. The other thing that came this is related to, especially when we buy livestock or we buy residential real estate, we have the ability to take, especially now, accelerated depreciation. And depreciation is just an absolutely wonderful gift in the world of livestock and residential real estate. The average, residential house does not decrease in value. Right. It goes up in value. Now it requires repair and maintenance and all that, and that's fine. But I mean, basically the real estate lobby has done something wonderful where you get to depreciate a property while it's increasing in value. We have the exact same opportunity with cattle. We can depreciate females while they increase in value. And you say, well, yeah, but they also depreciate. Absolutely, they do. But you can manage your herd in such a way so that you are only depreciating an appreciating asset, which is awesome.
Yeah.
And I'm going to separate.
I am a pastor by trade. That means that I have a certain set of deductions that are open to me,
yes,
that aren't open to the general public. And so I rarely pay in taxes, but the only two times I've paid in taxes are when I ran out of depreciation.
Yep, that's exactly right. And we have the ability to, so much more so after 2016, to manage the depreciation. Right. So I may need a lot of depreciation in a year. Well, I can set it up so that that's what I take without necessarily changing the underlying asset purchase. And conversely, if I need to spread it out over a longer period of time, I do. Now, I hear people all the time talk about how worried they are about accelerated depreciation, all that. I tell people all the time, I'm a huge fan of the option to accelerate depreciation. That doesn't mean we take it. Right. We may take it on a normal schedule if that's what we need. Right. But we have the ability. I mean, again, look at the prices of cows right now, the prices of heifers. You can wipe out a lot of income with accelerated depreciation on those. And again, I can be fairly certain that cow or that heifer are going to to produce more cash flow for me in the coming year.
Yep. Very good. I'm going to attempt to help somebody like me remember something here. So bear with me for a second.
Yes.
I need to connect things to other things in my mind to remember them. So I know I've heard that before, that only the next dollar is taxed at the higher rate.
Yes.
So don't worry too much about that. And here's how I'm going to connect that. Not every cow got the supplement, not just the cows that needed it, right?
That's right.
It's the same idea, almost the inverse of the same idea.
Yep.
And so
if
that helps somebody else remember that.
Yep. Yeah. So, this is why we always talk about marginal tax rates, right? So it's the tax rate on the next dollar, and that is what changes. And I think we sometimes think, well, wait a minute. And these cases do exist where you make an extra $100 and then you actually wind up making less money. More prevalent in the W-2 world than it is in our world. But those cases do exist, but generally that's not the problem, right? You just say, well, okay, the tax bill went up, but you're still better off. And so again, do you want to make more money? Again, I do. I want to make and keep more money. So that's the goal. So we do with it as we can. And I think, again, it's easy to get into these things where we really spend a lot of time worrying about something that probably doesn't produce that big of a change. I don't think, now I've seen some people encounter some horrendous tax bills that were, I can't think of any that were devastating to the business, but they were darn sure did short-term damage and were very expensive. But again, it was because there was a significant profit that was essentially not managed as well as it should have been. And they were caught by surprise. Excuse me. And I think that's another part. If we can segue just a little in the preparation part of this, we try to get every single one of our clients to begin looking at their potential tax bill as early as September. So we have stocker operators in the South Plains, right? They ship most of their cattle out in September, and then they start buying, or in August, let's say July, August, and then they start buying back in the fall. Well, there's a really nice downtime period there where we can meet with our tax accountant right then and say, okay, if this is our projection from now until the end of the year, what can we do? Now, for some people, if you're a cow-calf, producer north of I-80 and you're selling calves in November, you're kind of more up against it. If you've contracted those calves through a superior sale or something, you got a pretty good idea what your income is going to look like. Well, there's no reason not to start the process of tax preparation in the quarter or more before the end of the year. And that gives you the ability to make good decisions before there's a time crunch. There are things you can do after the end of the year. So we're at February 27th when we're recording this. I assume it's a few weeks before it comes out. You don't have many options right now for 2023. But in September, October, November of 2023, you've got all kinds of options. We try to push those meetings so that we have multiple meetings through the fall, so that we say, okay, here's what we think is going to happen to the end of the year. If that happens, here's what the tax bill could look like. And then you basically set it up as a nice formula where, okay, we didn't have the 100,000 in calf or stocker income that we thought we're going to retain those heifers. So now what does it look like? Okay, we sold extra calves or the price was better than we thought, or they were heavier. So now we have extra income. What impact does that have? And as we get down in the last quarter, we continue making those adjustments. It gives us the ability on 12/31, December 31st, to say, okay, we have a pretty good idea of what our tax bill is going to look like. And that, to me, is a very powerful strategy, right? Or a very powerful tactic, if you will, in a larger strategy of optimizing your after-tax wealth. Because once we get to January 1st, then people say, well, I could play games and I could predate checks and all that. Like, no, that's not, you're not doing it then. You gotta have it running months before the end of the year.
Right. And I think Dallas Mount, I maybe recently said this on the podcast that, maybe we go ahead and we pay the 5-figure tax bill, but we're able to squirrel away high 5 or 6 figures into future business resiliency. And I think a lot of people hear that 5-figure tax bill and they're like, but they miss the part about putting 6 figures in savings,
yeah, right.
Or whatever that might look like,
yes.
we should.
Okay, but the problem I have with that, and I have no argument with what Dallas is saying. Sometimes people say, boy, you and Dallas seem to disagree. Like Dallas and I are great friends. I have huge respect for Dallas, the school, the things he teaches, et cetera. So if you haven't been to the Ranching for Profit school, here is my plug. You have to go. If you haven't been to Wall.
And I was just in a workshop where he plugged your work, John. So awesome. It goes both ways.
we have wonderful visits, and I like arguing for sport. I know he does too, so it's good fun. So with that, where we see the problem is you generate it, and we'll get to this a little more later, but you generate a significant tax liability, but you don't have the money. And so, yes, I'm with you and Dallas when it's like, well, if I have to pay a $50,000 tax bill to put $100,000 in my account, like I'll think about that. The biggest problem, though, is when we have debt service and we have a significant IRS profit, but then our debt service takes all of our cash. Now we can't actually pay the bill. And I have seen a number of situations where they take the Ranching for Profit school. They work with us. They take Wally's Sell by Marketing school, or they take Doug's. They run out of accumulated loss. Suddenly drawing a blank on prior year loss, that they can deduct. They've run out of depreciation, and then all of a sudden there's a $150,000 tax bill, and there isn't $150,000 in the bank because they're paying it all on their mortgage and their cow note and a tractor loan. That's where you're not putting money in the bank and you're generating a significant tax bill. Now, in a business like Dallas's, Ranching for, the school, Ranching for Profit, he doesn't have, there isn't a mortgage per se. Now, I'm sure there may be debt on the business. I don't know, but that's a place where a cash cow type business can weather that well, because they usually end the year with the cash, and then that's what they owe taxes on. In a ranch situation, we often can end with a tax liability and not have any cash. And that's where people get in trouble. And that's where the preparation is very, very important. The not having the cash also can really limit what your options are even before the end of the year. So one of the things we can't do is prepay when we don't have money in our account. Right. So you can prepay expenses for the next year up to, reasonable limits and that sort of thing. But if you don't actually have the money, then the IRS won't allow you to do that. And so those are situations, again, the goal is after tax wealth accumulation for me. So if I have to pay some tax along the way, I'm going to be okay with it.
Right.
If I get hit with a $150,000 tax bill, though, I'm going to tell you I haven't done my job fully. That's too much, right? There's a limit there where it's like, right. Yeah, that's a lot.
Let's take a quick break and hear a word from our sponsor today, the South Dakota Grassland Coalition. If you're in the business of managing livestock, you've probably experienced drought, shortage of time, not enough help, and hefty debt. But facing one or even all of these challenges doesn't have to leave you worrying about how you'll make it through another year. Learn how to increase your stocking rates, extend your grazing season, increase plant diversity, retain moisture in your soil, spend less time and money on weed control, and much more at one of the South Dakota Grassland Coalition's grazing schools. During this 3-day intensive program, area producers, along with presenters from state and local agencies, combine hands-on activities in the field with classroom-style presentations to walk you through the steps necessary to create a grazing plan that suits your unique operation. Reserve your spot at one of the 3 grazing schools today at sdgrass.org. Is there more philosophically, and I know we've talked a little bit of practice on this too, but is there more philosophically, or can we move into exclusively talking about practice?
You bet. No, but let's maybe a little segue is to talk a little about entities. Is that fair? So entities, what do I mean by that? What kind of business are you? So most people in our industry are some version of sole proprietor or even a partnership, but they basically just, everything is reported on their personal tax return. There's no LLC or GP or general partnership or corporation, involved. That impacts taxes. It impacts liabilities, but I want to think carefully about how I say this. There are ways through managing entities that can help you or hurt you in your ability to manage your taxes. There are other non-tax reasons to do things like form an LLC or form a general partnership or form a corporation. Those are all fine and have their own validity. We want to be very careful when we do that, though, that we understand the interplay between the liability protection, for example, of an LLC and how that plays onto your tax return. How our tax election, even within an LLC, affects our tax return. So, for example, if I have an LLC that through depreciation, for example, generates a loss, I can use that on my personal return to offset my wife's W-2 income that she receives as an MD, right? So we want to think carefully about how we do that. I want to always go back to the rule of you want to keep that as simple as you possibly can, but you also want to be strategic about the benefits. There are benefits to different entity structures. I don't want to get into the details of that, but that is something worth looking into. There are some real disadvantages, and I really had a wonderful conversation with a tax preparer from Montana recently, where we were talking about the fact that at one time the tax law really favored one particular type of corporation. It was an S corp in this case, and so you see all these ranches in Montana and Wyoming that are S corps that blah blah blah. Well, the laws changed, and they no longer are a big advantage, and so maybe then you're looking for a way to get out of an old entity structure that was an advantage in the past and which no longer is. Those types of changes can be a little bit complicated, but they're definitely worth thinking through, because there can be times and years when it's like, ooh, we could set that up ahead of time and say, okay, we have this corporation that we'd kind of like to convert to an LLC, let's say. So, and I say convert in the loosest of terms, but we're going to change our entity structure, right? So what would be the parameters that would allow us to do that with the least amount of negative consequences to derive the most amount of future benefit? Well, it may not be in a year when markets and profits are high. It may be years when you have a drought and markets are low, right? But you could set that up and have it kind of all teed off to take place when those conditions arose. Now it's much easier going the other way, right? It's easier to go from a Schedule F filer to an entity. But again, you hear a lot of talk about S corporations, LLCs that elect as S corporations and all these great tax advantages. Well, some of those could go away, and that's a choice that you want to think about. But also some of those limit your options. You may or may not be able to take that loss that you generate in your company against W-2 income, depending on the tax election of that LLC. So, for example, an S corp has to keep its losses basically self-contained, meaning you can't use that on your taxes to offset other types of income. So, again, I don't want to get into the details of that, but they do matter, and I do believe there is great reason to be involved to actually form an entity, but I want to keep that entity just very, very bare bones simple. For lots of reasons.
Right. And I think that when you and I were having a conversation about this, when I was looking at setting up an LLC for the podcast, that you told me at that time, at least, that there was some number of months after the formation of that where you could go back and retroactively change it to another form if the income became such that it made sense to do that.
Yep,
is that
is absolutely true. And I will say the IRS and the federal government especially are pretty darn forgiving in your first year of operation. They basically understand that, oh, you're new at forming an LLC, you're kind of a dummy, you're going to screw some stuff up, and they're pretty darn forgiving. Now, again, dealing with the IRS is its own things. Even just getting letters back and forth from them, it can be incredibly time consuming. But they are set up for to help new businesses, basically. So yes, I think that what we were talking about was like you have 75 days or whatever to make the S election after the beginning of the year, which would be retroactive to the first of the year.
Right. And I think that another thing that, as I've set up 2 LLCs in the last year, one of the things that the lawyer always repeats in that meeting where you go in and sign your documents is keep your personal expenses and your LLC expenses separate, because you vaporize the liability protection. If you don't, they're going to pierce the corporate veil, is what they call it, and then you personally are exposed to liability, not just the company. So I think that bears repeating.
It bears a lot of repeating. And this is where simplicity matters, because we see it too often. We see it a lot with people coming to us they've been advised by an attorney to make things too complex. Well, as soon as you don't follow the rules, all of the protection that you think you've signed up for go away. And it's not exactly that clear cut. There's a great book, Fail Not Fail, if you've ever seen that one. Written, I can't think of the guy's name, an attorney, but I mean, again, there are lots of ways to make these things fancy, make them really hard, and then you generally make them completely ineffective. Now the other thing you have to remember is every additional entity requires its own tax preparation, right? So you also add expense. There is a level there where, if you're not making enough money, it's just not worth it because now you have to pay extra in tax prep. Well, we don't want to do that. That's why we want to keep it really simple. Things like the very simple LLCs, either sole proprietorships or even partnerships, but LLCs with a partnership type tax election are very easy. They don't add a lot of extra time. They don't add a lot of extra complexity. They add some liability protection, but you have to follow the rules. Going to a corporation is a whole nother level of stuff, right? Then you have to have a board of directors. You have to file reports. Like it's a pain. And the tax returns are generally more expensive. And at this point, in a lot of cases, the way the law is now, the benefits aren't that great. In some cases, specific cases they are, but sort of across the board, they're not nearly as good as they could be. So I think that's a really good comment, Clay. Again, we want to do this at the right level. And we talk in our company, we talk a lot about transformations, right? What are we trying to do? We're trying to help people achieve their dreams, right? Every business is unique. Everybody's dreams and vision are unique. Everybody's needs are unique. But the single most common transformation most of us need to make is exactly what you talked about. Get the personal separated from the business. They teach that in Ranching for Profit. We teach that again and again. We repeat it again and again. It makes your life so much better. And it frankly makes your tax preparer, makes their life better. So when we talk about preparation, having a separate business account where business transactions reside, even if it's just a personal account that you have a separate debit card for and use for business transactions, that makes your tax preparer's life way easier. And again, the tax preparer charges by the hour. So if you're making his or her life easier, you're probably making your bill less. All right. So should we jump into some specific numbers about things you should do?
Yep. Practical.
Right. So okay, there are some best practices here. Keeping track of receipts is very, very important. So we already talked about separating business and personal. So now let's say I have a checking account that I only use for my business. Whether it's a business checking account or not, doesn't really matter. It only gets used for the business. Just for the record, I'm not a big fan of Profit First. I have seen people use it and use it very effectively, and it has done wonderful things for them. Most people I see that use Profit First is a system of setting up a whole series of bank accounts. There's a book by the same name. If you're interested, I don't recommend reading it and following the advice, but you could read it just for personal info. It sounds like a great idea. You set up all these different accounts. You put money in the different accounts for the different things. So for example, you have multiple checking accounts or a checking account with multiple savings account. You say, okay, I'm going to pay myself X dollars and I'm going to put X aside for taxes and I'm going to put X aside for peanuts, and I'm going to put X aside for whatever. Often what we see is people do great at it for 3 months and then the whole thing sort of implodes. And then you just have transfers going between different bank accounts. It makes no sense. And you save money by accident by kind of hiding it from yourself because you can't transfer it. My biggest problem with Profit First, I see a lot of people that have money in the bank, but they write the check off the wrong account. The check bounces. And so then they wind up with check fees. And it's like, well, this is dumb. Why are we doing this? So I don't recommend that, but it's an approach. If you're going to do something like that, I don't mind a separate account for things like payroll taxes, right? So I have an employee, right? I write him a check for $100 a year or whatever it is, whether he needs it or not. I have to take out his self-employment tax, right? And I have to put in my portion, or I said self-employment tax, I meant employment tax. 7.65%. And then I have to put in my match, which is the other 7.65%. I am not uncomfortable with an account that tracks that just so that you never mess that one up. It's very, very important. I think there are better ways to do it. We do it through your balance sheet and show what that amount is constantly, so we always know that it's there. But you could do that with a savings account. You're not going to bother me in the least. But once you're up to like 6 bank accounts, past 3, you're not managing it well. I promise. It takes more time to manage it than the benefit it provides.
Right. You need a CFO at that point.
Correct. Yeah. And you're probably not Apple, so you probably don't need a CFO. Okay. So with that, keeping those transactions separate and then documenting them. Okay. Now we see business owners that think, oh, I own a business. Everything I do is deductible. Like, no, it's not true. So one of the other transformations we work through with people is, yes, when you stop and get a 6-pack of beer on the way home, just because you pay for it with your Ranch debit card doesn't make it a work expense, right? There are just all these things where it's like, yeah, remember what the rule is, right? It has to be a reasonable and justifiable expense for the business. So if you live in a town and you live, 30 miles out of town and you eat lunch in that town every day, there really isn't a tax deductible expense. Okay, that is you eating lunch out. Now, one thing to remember with meals, again, 2016, I think has done some wonderful things for us, but this isn't terribly popular. There used to be a category called meals and entertainment. And in a lot of accounting software, it still is labeled as that. Entertainment is not deductible anymore. So if I'm taking people to football games, to wow them as clients, that is not deductible. And meals are only 50% deductible. So I did the math a couple of years ago, and I think it cost me 4 or 5, I think it was 5 times more to eat out than it cost me to eat at home. And I only get to deduct half of it. So I am actually losing. The other thing you're doing, if you're eating out all the time or incurring additional expenses, so for the tax deduction, is you're making your business suck. Right. And again, our goal is a profitable business. So especially if you are starting out or you're in kind of you're trying to get this business to a new place, don't spend all your money eating out. Like that doesn't make your business run better. Right. Spend money on things that make your business better. That's where you really need to stay focused. And again, the tax deduction doesn't turn out to be meaningful enough to make any difference. Okay, so let's go a little further on meals. Technically, if you take someone to lunch as a business expense, that has to have a business purpose. And you should be documenting who you have that meal with. And if these are potential clients, as an example, if you were to get audited, those could be looked at of, did these people actually become clients? So, calling everyone you ever go to lunch with a potential client is really not a great idea. Now, I periodically take potential clients to lunch. My conversion rate is high, right? So I can say, yes, I took that person to lunch and they did not become a client, but I took 8 others that did become clients. So, I think we're okay there. Reasonable and justifiable is the thing you got to come back to. What is that thing? What is that expense doing to contribute to your business? I'm going to say again, I've said this 100 times in the last couple of years. You recall that part of the big Biden administration's deal was to hire a bajillion new IRS agents. The IRS has been behind the 8 ball. They like to whine about how underfunded they are and how bad they have it. They are trying to fix that. They have a lot of new agents coming, and I think audits are going up. And so you may have been able to get away with this for years. You might not continue to. I think we want to run a good business. I think when you have a good business, the rest will take care of itself. Let's go.
Is there an interval at which people should expect IRS audits? I mean, no, it's just random.
Not that I know of. I mean, I don't know if it's random, but
right.
I don't know that there's an every 7 years you're going to talk to them.
Right.
We definitely see our Canadian customers get audited a lot. Our U.S. customers, it doesn't. It's rare.
Right. Yeah. And we've owned small businesses pretty much continuously for the last 15 years or so, and have never been audited. But that's just exactly. Knock on wood.
Yep. Very good.
But we've never filed taxes without a CPA doing it. So that's
right. And that is an important part of strategy, right? I hate to pay that guy to pay my taxes, to file my taxes. I could do it. Yeah. Well, one of the things you're getting when you file that is somebody who's also going to be in your corner when it comes time to have that discussion. Their name is on the bottom as well as yours. Right. So Now that reminds me, you will occasionally run into a tax preparer that won't sign your return. They'll help you prepare it and then you sign it. That's not the way it's supposed to work. They sign the return, their name's on it. They're not liable for
Right.
the liability. You're on the hook for the liability, but you do want someone knowledgeable in your corner when it comes time to.
Every tax preparer I've ever signed taxes with has had you sign another document that says, I didn't lie when I gave you these numbers.
Correct. and they show that to everybody that will listen, right? Which is, hey, you didn't tell me. And it's a garbage in, garbage out system. If you don't tell me about a bunch of income, it doesn't work very well. Which quick segue, trading. Lots of people think they're avoiding taxes by bartering. Not correct. Now, usually the barter works out fine and doesn't actually create a tax liability because it's even, right? But if you're bartering hay for tools, right, that's a 1-for-1 type. If you're bartering your labor for stuff, that's a little different. So you want to be careful there. But again, under an audit, and I'm not a tax preparer, but that is going to be looked at and probably disallowed.
Sure. Other practical things we've talked about: keeping track of receipts.
Okay, so let's continue with receipts. Normally, there are a couple different ways to do this. There's the old school way of just shove them all in your glove box and deal with it later. Soy ink. I don't know if it evaporates off, rubs off, whatever, but all these new receipts that come out of gas pumps, as an example, leave that thing in your glove box for a week and you will not be able to read it. It will be gone.
Right.
Okay. We have an obligation as the taxpayer to keep documentation of our expenses. In 1990 something, the IRS, I think it was the early 1990s, the IRS allowed digital copies of receipts. So, for example, a photo that you take on your phone. Now, in 1990, we didn't have phones, right? So, and we certainly didn't have phones with cameras. We had phones, but they were tied to the wall and had a cute curly Q cord. There's one in the background that you just can't see. Right. Taking a picture of a receipt is valid. Now, you have to be able to read the receipt. You have to be able to see the vendor name and the total at the bottom, how you paid for it, that sort of thing. But that is a legit way of keeping receipts. Now, there are old analog ways. What I used to do is I'd get my bank statement and then I would have all the receipts and I would attach the receipts to the bank statement. I'd go through the bank statement, check off all the ones I had, staple or paper clip all the receipts to the bank statement, put it in a manila folder, put it in a file drawer. The next month I would do the same thing. And then at the end of the year, I had 12 months of bank statements, all the documenting receipts with explanations written on them, hand that to the tax preparer. That's labor intensive and takes work. I think I was spending a day a month doing that with a little feed yard, right? I mean, it was a lot of work. Now we have a wonderful tool that we use, and there are a number of others like it, but there are also a bunch that are garbage. So I would be careful here. Dext, D as in Delta. It's spelled like next. Okay. DEXT, T as in Tango. Is a wonderful piece of software. It's fairly cheap, links super well to accounting software. It has great security features, is a relatively low cost. It is a wonderful app that you can put on your phone and on your computer. You can create an account. For our customers, we create that account. We do all that for them. But then whether you're one of our customers or not, you can use that software, have the app on the phone. When the receipt comes out of the gas station pump, take a picture of the receipt, categorize it, be done. And it will actually push a copy into your QuickBooks that you can match up with your bank transactions. It also has a wonderful digital archive. It's not the most user-friendly, but it's super good. And so it's searchable, that sort of thing. I have heard of multiple cases where people get audited and they have been very good users of Dext. It used to be called Receipt Bank. It was purchased a few years ago and the name changed. And those Receipt Bank users were able to, when the IRS auditor asked, what was this expense? They basically were able to say, bang, here's a copy of the receipt, like in seconds, right? What was this? Bang, here's a copy of the receipt. You do this a half dozen times, you're pretty convincing. Your credibility is good, right? Whereas the old, like, oh, we'll impress him with how disorganized we are and we'll make it all really hard. Like, they're only thinking of ways to get you the longer they have to wait, right? The more you can just get them on their way and out the door, the better. So again, Dext is something I strongly recommend. QuickBooks, most everybody knows we use QuickBooks a lot. QuickBooks has its own app. It is terrible. I would not recommend using it. It's better than nothing, but it is really bad and it's not very functional. There are a few others, and I am drawing a blank on names now, but there are a few other programs. I would look into that. And there are some free ones. Dext, I think, costs like $20 a month. It is a paid one, but like I said, I think it's the gold standard. It is easy to use. It has a great interface on your phone, works well with your camera, all that stuff. So to my mind, that's the best thing you can do. And if you're working with an accountant who knows how to use Dext, that means they can actually set it up so that all of those automatically come to them. So for our customers, they take a picture on their phone. They don't really have to do anything with it other than take the picture and push a little green submit thing, and it shows up on our computers. So it makes the process of carrying receipts and keeping track of them very easy. Now, I'm paranoid and I've kept receipts for many years, so I still actually keep a paper copy of the receipt, but I don't do all the filing stuff that I did before. I just throw it in case something, I've got a drawer, I throw them all in there in case something happens. Lots of people use Dext and literally just they take the picture of the receipt, throw it out. I have done that a little bit, but every time I do it, it's like, oh, what if it doesn't work?
Yep. Very good.
So that would be one. The other one is, you want to, and let's go a little, let's talk about some specific things. We've talked about preserving receipts. I want to talk a little about making sure we understand how taxes work, because tax accounting and business accounting or managerial accounting are very different. And we need to make sure we understand the sort of fundamental basis for how our tax system works. Now, you've heard that, you can file as a cash filer or an accrual filer. In the US, I'm going to claim the accrual filing it's very weak. It's not real accrual by the definition I use. And the reason being is it's primarily, money in, money out. And there's some debate about, well, you wrote the check on 12/31, but it didn't get cashed until the 3rd of January, right? I'm not that interested in that. It really doesn't matter that much, right? But the idea that when we have assets on our tax return, they have what's called a cost basis or a cash basis, or just a basis is probably the best word to use. And what that means is you paid for that asset. So I went and I bought a cow a few years ago and I paid $900 for her. Okay, if I didn't take any depreciation on her, then she's worth $900. Well, let me back that up. Let's take depreciation on her. I'm taking $100 a year of depreciation on her. So, 2 years later, she's worth $700. Okay. We need to understand that cow, no matter what I paid for her, she has a tax value, which is that cash purchase price minus the depreciation. Okay. But she also has a market value, and those two things can have no resemblance to each other whatsoever. So a year ago, I bought some cows for $1,175 that are currently worth $2,500. Okay. Doesn't matter for taxes, right? Now, it matters in the fact that I'm going to have a gain there. But when I'm depreciating that cow on my taxes, for example, it's the purchase price that matters. And we need to really understand the difference between something's value and its basis. Does that make sense?
Yep.
Okay. And this is true for all of our assets. So 2021, truck prices went up, tractor prices went up, right? All machinery went up. But you were still dealing with the purchase price in dollars the day you bought it. Okay. And there's a big important difference there. A place this shows up a lot is also or a related idea shows up a lot is accumulated depreciation on your balance sheet. So when you buy a tractor for $100,000 and you depreciate $10,000 a year off of it, let's just say, year 2, it's worth 90, year 3, it's worth 80, year 4, it's worth 70. Okay. A lot of tax accountants put that accumulated tax depreciation on your balance sheet, which is great. Kind of. I want them to keep track of it, but my tractor might actually be worth more in real life than it is on my tax return. When I take a balance sheet to my banker, I don't want them to worry about what I've got it on my tax return on. I want them to worry about what's called a fair market value. What could I reasonably sell that tractor for today? That's what I want it to be on my balance sheet that I present to the bank. Does that make sense?
Mm-hmm.
Okay. So for example, if I take accelerated depreciation on that tractor, okay, and I take and I show it as worth $10,000 on my tax return, I'm not going to go to the bank with a $100,000 tractor that's 6 months old that I took accelerated depreciation on and say that it's worth $10,000 for lending.
Right.
That makes sense.
Yep.
So tax, as again, Wheelwright talks about, tax has its own very specific rules of the road. We follow those rules. We abide by them. They are the law of tax, but they are not the law of other things. And it's very important that we recognize a clear difference. And we have people all the time like, well, my income on my tax return was, well, I don't have any interest in that because I can tell you what my income is. And, there's no resemblance. Mortgage people sometimes will get very confused about this. I've seen a couple of cases where someone took accelerated depreciation to create a business loss that they could then use to offset W-2 income. And then the mortgage, I'm going to call them a mortgage seller. I don't know if they were even as qualified as a broker, and they certainly weren't an underwriter, looked at that and said, well, you can't do that. You don't have enough income. And it's like, yeah, that's because they had 179 depreciation that wiped out $300,000 worth of income. You have to add that back to get a mortgage, right? So there are all these places where we want to make sure we understand that the rules of the road are very different. And that's maybe a little less than practical, but I think it helps to guide how we walk through these things, right?
Yep. Very good. Very good.
All right. Another very important thing that people need to be aware of is their tax history. So carry forward loss is a very important thing. Lots of people have it. Nothing to be ashamed of. It's just one of those things. Depreciation and the depreciation schedule you are on matters. I've mentioned that we have some real flexibility in depreciation, but you have to choose. And then once you choose a path, now you're on it. So you want to make sure that you sort of abide by those choices and deal with them correctly. I really like thinking about taxes in a 3 to 5 year window. It is possible to create a situation where I minimize tax 1 year and then hurt myself the next year. And it has to do with those brackets like you talked about, right? I could push a lot of income into higher brackets the next year. Whereas if I'm reasonably level at a low to moderate tax bracket year in and year out, I could be, sort of serving my business the best. Carry forward losses are kind of a fun one. You want to be aware of those. And again, this is what these prior to end of year tax meetings help us do, because we see lots of clients who, and again, we're working with their tax preparer, right? But they have a carry forward loss, but they're worried about a tax liability. It's like, don't even worry about it. It doesn't matter. You have, basically a get out of jail free card here in this deal that in many cases is worth hundreds of thousands of dollars. But what often happens that we have seen multiple times, and this has happened since Stan Parsons had RFP. I know some of the old school RFPers and HRM people who turned a bad business around dramatically. And what happened is they had carry forward loss in the early years. And so they used that loss, right, as they converted to profitability. And they weren't, I don't know if I see places where the tax accountants don't really believe that this is going to go on, right? So they don't worry about it much. And maybe the business owner isn't communicating very well with the tax preparer. Well, they're becoming increasingly profitable 3 to 5 years post, RFP. And during those first couple of years, they have carry forward losses. So there's no tax bill generated. And then all of a sudden they run out of carry forward, they run out of depreciation, and now they have a $100,000 tax bill. And they're wondering what in the world happened. And that's a place, again, the practical part is please be communicating with your tax preparer. That person they're not the driver of the bus, but they're a very important member of the team. And you need to be aware of what are the implications of these things, because carry forward, I feel like, is the one that catches people by surprise. They don't understand why they're not paying any taxes, but then they just don't worry about it. Again, worry about it at the rate you're paying, but beware if there's a cliff coming. Yeah. And if you run out of losses in 1 year, that can be a pretty stout thing if you've converted if you've converted to a very profitable business that has no tax strategy. So for example, a custom grazing business is what I call a cash cow business. If you're a custom grazer on leased land, right, you really don't have many expenses. This is the reason it's so profitable, right? You don't have many expenses. You don't have any assets, right? You just have cash income. Well, word to the wise, a custom grazing business is like having a W-2 job. It could generate a significant cash liability. And again, in the early days of RFP, there were people that experienced that.
What else is on your list? Some other major things, key points that...
Yeah, a few other things. Government payments, and there have been a ton of them here in the last few years with the COVID deal, are often taxable income. You will often get 1099 for them. Seems weird, right? The government's going to give me money and then they're going to turn around and tax me on it. Like, it's awesome. One of the hardest things about our planning process is that the freaking FSA just will send payments out randomly and it never fails. You've got somebody that's on the bubble, like, yeah, we've spent enough, that sort of thing. And then an FSA deposit shows up for a drought that happened 3 years before, blah, blah, blah. It never fails. Those things are out there, but again, plan on being taxed on that. Are some of those that are not taxed, but those are the minor exception, if you will.
Right. Yeah. CSP, equip, all that stuff.
All that stuff,
Yep.
All taxable. The fence grant, the stock water grant, all those things. Same with money you receive from the state wildlife fund. If they're doing that, like almost all those things are taxable.
Yep.
I am lucky to live in a state with no income tax. There are Wyoming, Nevada, South Dakota is one, Tennessee, Texas, New Hampshire. I think half dozen or a dozen of them that don't have state income tax. If you live in a state with state income tax, you need to pay attention to that. You need to be careful. Again, California, Illinois, New York are sort of the classical, terror zones. It's just one of those things you need to be aware of. And with that, I want to bring up this idea of both payroll tax and sales tax. We deal with a fair number of direct-to-consumer type businesses that are surprised by sales tax. We deal with a number of service businesses where, it's a ranch, but then they have a service business. That service business can get caught by surprise because in many states they owe sales tax. New Mexico, in my mind, is my favorite example of a terrible state for sales tax. It's county by county. The rates are high. Colorado's bad too. And you're the one responsible for collecting it and reporting it to the state. We have seen cases where people don't do that for a few years, and then suddenly they have a 6-figure sales tax bill that they owe to the state. I think the highest rates I've seen, I think, are, in the West. New Mexico and Colorado seem to be the worst, and they're pretty good about enforcement. With that in mind, if you screw that up, best thing you can do is get with a professional, do a mea culpa. New Mexico, for example, has what they call I can't remember what they call audited review. Is that what it's called? That, it's basically a self-reporting thing. You'll go through and determine what you owe. They'll look it over and give you a thumbs up or thumbs down. They're reasonably forgiving about it, but not unlimitedly so. So you want to be careful on that. And again, pay attention in your state to the laws of, especially if you're selling stuff into different states, of what the laws are about selling or performing services into another state. Most states don't tax food, but some do. And you don't live necessarily by the rules of your state. You live by the rules of the state that you're selling in most of the time.
Right.
Which brings us to if your business is significantly direct to consumer, the IRS does not consider meat an agricultural product. Now, you can make a joke about this if you want. Yeah. Exactly. Cue Clay banging his head against the table like, what the heck? Okay, meat is not an agricultural product. A calf is an agricultural product, and wheat is an agricultural product, but bread isn't. Okay, and so for that reason, that actually changes. If that's a significant part of your business, that actually changes the way you have to file your federal tax returns. And most people don't realize that. So that's a place where we see people get into trouble. The other place where we see people get into trouble is with payroll tax. We talked a little about it earlier and having an account for it. Most people don't realize that they have to pay payroll taxes. Many have to pay monthly, but usually at least quarterly. And if you're writing checks to somebody and we'll just make it up at the end of the year, that is going to get you. Payroll tax is a bit of a different deal because when you withhold money from someone's check, so Clay, you're an employee of ours. I pay you money. I pay $100, I keep 10, or I keep $7.65, right? I have taken that money away from you. And if I don't pay it to the feds on time, they get pretty upset about it. And for good reason. You've taken the money away and then you've not paid it, right? And again, remember, you have to add $7.65 of your own, right? So there's an additional liability there, which we can argue about. But you, business owners, are entrusted with the responsibility of collecting that money from employees and getting it to their, getting it to the right agency, right? To the feds. We see a lot of places where people are way too casual with payroll. And we'll get a call at some point, hey, I need to get payroll taxes paid for last year and we didn't do their payroll, or they're not a customer of ours. And it's like, yeah, we don't do that. You need to go to somebody that does that. And I hate telling people that, but it's a headache to get it cleared up. We do it sometimes, but it's a problem. Payroll tax is a payroll tax, and sales tax are the kind of thing that are a severe administrative burden, and you need to be set up correctly to deal with them. It doesn't have to be expensive or time consuming, but like all things, prior preparation makes all the difference. Government payments, all the other types of taxes. And then another one that I want to make sure people understand when we talk about, when we're in the stalker business, we often, take the South Plains as an example, right? Kansas, Oklahoma, North Texas, all that area. When we are buying stalkers in the fall and selling them the next year, let's say in the summer or the fall again, the purchase of those stalkers is not deductible until they are sold. They are considered a cost of goods sold by the tax rules. And so that different from purchasing a cow where I can deduct her the current year, right? A stalker calf doesn't show up until the next year. So in years like this past, where we were often buying calves in 2022 in the fall, right, for $900 a piece, and then selling them in August of 2023 for $1,500 to $1,800, and then buying back a calf for $1,500 or $1,800, we are only able to deduct the prior year's expenses, right? So we have a significant increase, right? A significant short-term gain there. The buyback on those calves doesn't apply until the next year. This is actually something I think is a bit of a problem in our tax code, the way we do things. Nobody cares about my opinion. But I, as a sell-buy advocate, of course, I would argue that we should always be selling and then replacing with the buying back. Again, it's a place where the tax law differs very different, is very different from business management. That's an important record to keep with your tax person. Your tax person, now, especially if you go to a new tax person, they need to be able to figure out, of the cattle you sold, what did you pay for them? And that number comes, oftentimes from the prior year. So we have a system that we use to keep track of that that's super clean. You need to make sure you can do that. One of the reasons we advocate so strongly for things, like inventory management, written, computerized tracking of inventory is for exactly that reason. It gives us the ability to track the actual cost of what we bought and what we sold.
John, I think this might be the lowest percentage of talking I've done in an episode to date, maybe in 350, 8 episodes this might be. And that's because you were very prepared, and I appreciate that. And I was sitting here, learning and, just taking it in, and you were thorough and answering a lot of my follow-up questions before I got to ask them. So were there other things you wanted to cover and things that I should have asked, follow-up questions I should have asked that you want to touch on now?
No, I think you're good. We could talk about this for hours and nobody would listen. So when you look at your listenership and they're like, oh, taxes. Yeah, I'll never listen to that episode. No, I think we've covered a lot of it. I'm going to repeat never cheat on taxes. The tax code are the rules of the road. Use them to your advantage. We're given tax advantages in our industry. Use them. I believe in optimizing your tax rate, not necessarily minimizing it. My goal and the goal of many of us is to maximize after tax wealth. So don't be, Ranching for Profit says, don't worry about taxes. And I generally agree with that. That said, when we deal with very profitable customers who've done a great job implementing all of these things, taxes become one of your largest expenses. And at that point, they deserve serious attention. Yeah. And that serious attention comes in preparation, right? In planning. It comes from strategy and good tactics related to your strategy that allow you to build your business. Over and over again, I am absolutely amazed by our customers and their ability to generate significant profit and convert that into wealth. And that is an awesome thing to watch. Over and over again in our industry, we hear about how bad it is. I don't see that on a daily basis. I see how good it is, and it is really good.
Yeah, very good. Well, John, thank you so much for your time today.
Clay, it's an honor. I love what you do. You know that this is you have begun a whole trend of things that has transformed education in our business, and I absolutely love it. So thank you. It's a real honor to participate. Appreciate it.
Thank you. I appreciate that. All glory to God. Very good stuff there, as always, with John. Really appreciate him taking the time, and really looking forward to next week on the Working Cows podcast. We will be talking to somebody from the team at Understanding Ag, taking a deep dive on some of the principles that they teach in their schools, the Soil Health Academy, and some of the work that they're doing with Regenified and all of the other things, all the different ores that they have in the water over there at Understanding Ag. So looking forward to that, and we will see you again real soon on another episode of the Working Cows podcast.
We invite you to visit workingcows.net to subscribe to the show via iTunes or Stitcher. You'll also find detailed show notes pages, resources from our guests, and the industry leaders who have influenced them. For more ideas on putting your cows to work for you in a more profitable way, tune in next week.